battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. It's episode 166. We are the Stenger Family Office. For the past 43 long years, the Stenger family has been providing you clarity and confidence to help secure your financial future. And you are thinking to yourself, oh my goodness, I am so happy I listened to the Nick Stenger Show. I'm so happy I've been sharing it with my friends and family. I am so glad that I am subscribed and getting all the alerts and updates, because without the clarity and confidence, without the good news, I would have panicked long ago. And if you're like most of us, you need some grief sharing, you need some data, you need some math and statistics, why you should stay in your plan. I need it just like the rest of us. And if there's any reason better than last week to have the data, math, statistics, and stay on a long-term plan, it's this. You saw that nice old pop on Tuesday. We got our election results in. Pretty much everybody's a Trump supporter now who has money in the market, because the market's up 5%. We're at S&P 6,000. I guess somehow we timed this out here. Episode 166. It's S&P 6,000. Okay, somehow we got the timing perfect. You could thank producer O. Not sure how we nailed that so well, but here we are. And it's a historic moment. I mean, this is a really big deal in the stock market, because you got to remember, a lot of people were so bearish going into 2023, going into 22, going into 24. All these years, there's always bears, but it was really bad going into 2024. We made that bold prediction at the end of last year when the S&P was right around 4,700 points. We said, hey, we think S&P's undervalued. We think fair value is 5,300. Well, we got it wrong, but we got it wrong on the other direction. The S&P now is 6,000 points. So it overshot even our most bullish case, which was 5,400. And you think, Nick, oh, that's easy stuff to do. It's not that hard to say that now. Well, at the time, it was really tough to come out and say 5,200. And if you go back and look at all the analyst estimates, JP Morgan said 4,400 or 4,500. Morgan Stanley said 4,500. Even Stifel said 4,700. And they all got it wrong. Goldman Sachs got it wrong. They all got it wrong. And not to brag, I don't want to brag here, but we did get it right. And again, it's not hard to get it right if you just look at the math, if you can put aside the narrative. And then that's really what it is. So I am kidding. We're not bragging. We're not trying to say we're going to get it right every single time, because there are times where we don't directionally get it quite right. But I think if you're an optimist over the long run, you will do well. You'll do at least better than the bears. And so the bears on Wall Street typically get it wrong, because statistically the market just goes up more than it goes down. And you think, well, that's not hard to understand, because if you look at 200 years of market history, market's up, right? So it had to have gone up more than it went down. It's just common sense. So if you're going to be one thing, if you can only pick one way to be, and you had to be a perma something, if you had to pick between perma bull and perma bear, you would have always wanted to be a perma bull. And that's what we are. Not all the time. We're not always bullish. We're not always sunshine and roses. We've called balls and strikes as we've seen it. We've said that government spending's out of control. We've said the government's too big a part of GDP, and that's all true. But I'm going to tell you today why. Again, not a political statement, so don't hear this wrong. Don't take this as a political thing. But I'm going to tell you why I think the market is going to continue going up, why I think the rally is just getting started. While we may have a correction at some point next year, it's coming at some point. We're going to give some back, and then we're going to go back up, I think, to all-time highs again. But the reason I think the market's just getting rolling is you just look at Argentina. And the Argentina stock market under Javier Milei now, just for 2024, is up 40%. You remember the famous video where he's in front of the whiteboard and he's got all the names of the government institutions on the whiteboard, and he's going through one by one and he's saying, you're gone, you're gone, you're gone, you're gone, you're gone. And he's not saying that we shouldn't have people in our economy that are watching for things or protecting things or helping with education, for example. He's not saying any of that. He's just saying, let's put it in the right spot. Do we want government to be in control of everything, or do we want it to be private markets? Do we want it to be entrepreneurs leading the charge? And so now with Elon Musk, he actually just visited with Javier Milei, and I think a part of that was to bring some of those ideas back to the United States, because now Argentina has gone from 30, 40% inflation inflation down to like 2 or 3%. Why? Because they're shrinking the size of government, and government spending is inflationary, not directly dollar for dollar, but when the government crowds out, when public spending crowds out private spending, it hurts entrepreneurs. It makes the government slow down the individual and the entrepreneur and ultimately growth. And so if you want to live in a better world where medical is better than ever and people live longer and cancer is getting treated better and people are surviving terrible diseases they used to die from, if you want more of good things and less of bad things, and you look at 200 years of market history, you should want entrepreneurs running that. And we just had our investor day here in Naperville. We had Andrew Opdyke who said, hey, regardless of whether Trump got into office or Kamala got into office, he said markets were going to go up no matter what. We kind of said the same thing. We said that the stock market has continued to power forward, not because of politics necessarily, in just because of politics, but because of entrepreneurs. There's not a single senator. This is Andrew Opdyke's quote from the event. He said, there's not a single senator who has invented an app, for example. It's all entrepreneurs. Now, I will just throw one caveat and say this: now that the election's over, I do think it's better for markets to have pro-freedom, pro-business agenda and policies. So I am very clear on that. We want smaller government. So wherever we get it from, in the past, we did get it from Democrats. Actually, a lot of Democrats, historical liberals or classical liberals, as you would call them, used to be smaller government. They said, we don't want to be involved in 55 different wars. We don't want to be the world's policeman. We don't want to be out there, constantly trying to parade around and get involved in all these different conflicts and keep the U.S. smaller. And in fact, it was the Democrats who were the party of anti-immigration. If you go back and listen to speeches from Bill Clinton, he said, we've got to close our border because it's destroying U.S. manufacturing jobs. So this is not a new idea. This isn't a Republican idea. This isn't a Democrat idea. It's just a pro-America idea. And so I think these are good policies that we're seeing. If you want to know why Trump won, and again, not a political statement, I'm not endorsing anybody for president, but I'm just telling you from a policy standpoint, if you want to know why Trump won, it's because of immigration, it's because we're going to get lower taxes, I believe, but also because we're going to get less regulation. And when you have less taxes, so you shrink the size of the amount of money going to the federal government, and you shrink the amount of regulating the federal government can do, you end up with less government. And it's not like government should exist. I believe as a Christian that government is ordained by God. You have to have government unless you want chaos. But when government gets too big as a portion of spending, when it gets too big as a portion of our economy, and it gets into every single aspect of our lives, again, it slows down innovation. So you watch innovation, you have a front row seat to some of the coolest stuff going on. I would just turn your attention to Elon Musk, who is innovating at light speed. And the guy is obviously a little out there, a little weird, kind of a strange guy, but you cannot deny the fact that what he's doing with SpaceX and Starlink and even Tesla with the autonomous driving, they are logging 2 million miles a day now on FSD on Tesla. And whether you're going to get a driverless car or not, that's fine. But when it gets into autonomous and robotics and AI, the closest competitor to Tesla is only getting 2 million miles of FSD a year. And so they're doing that in a day. And so this is pretty neat stuff. We covered it at Investor Day as well, that Starlink now is getting internet to the most obscure places on Earth, even places where you've had horrible floods and horrible storms and just horrific events, natural disasters. Comes to mind would be North Carolina. And within 4 days, Elon Musk comes in and makes Starlink free internet available to anybody who wants it for free. And I just think that is the neatest thing. And you take that, you expand that to communist countries, you take that to places where literally they have suppression of free speech, they have suppression of the truth. And now we're going to be able to get the truth to these places. Man, if you want democracy, if you want freedom of speech, if you want more freedom on a worldwide level, you should want entrepreneurs leading that. It is just the coolest thing. So that's what's going on. And again, I'm not telling you that we're more optimistic or less optimistic that Trump won. I'm just telling you from a policy standpoint, just like you saw in Argentina, I think you're going to see the U.S. stock market continue climbing higher. Again, it doesn't mean we're not going to have a correction. It's not that we're not going to have some problems ahead. We had corrections during the Trump administration, but the previous Trump administration. But I think now you've got a good sense that government's going to shrink. Number one, that's a great thing for entrepreneurship. I think regulations are going to come down, and I do think taxes are going to go lower. We're talking about instead of 21% as the corporate tax, we go to 15. You say, Nick, isn't that horrible for government? We already have a horrible deficit. How are we going to get our deficit under control? Well, guess what? Now you may not like me saying this. You may be mad at me for telling you this, but you go back to the last time Trump cut taxes in 2017, and we brought in more federal tax receipts after the tax cuts than we did before the tax cuts. So that's the reality. And I think you're going to see this. Remember, the world the U.S. doesn't operate in a vacuum. We play on a global stage. And so if you raise taxes in the United States, and that makes the U.S. uncompetitive, what do companies do? They leave. And it's just as simple as you and your family saying, well, I don't really like the cold ice, sleet, snow, and rain in Illinois, so I'm going to go to Florida, and I'm not going to have a state income tax, and I'm going to have beautiful sunny weather. So it's just that simple. Companies do the same thing that you and I do, obviously on a much bigger scale. But the reality is I think over time, you're going to get more jobs back in the U.S., you're going to get more manufacturing, you're going to get better outcomes for U.S. citizens. Now, that's all the positive stuff. Let's talk about the negative stuff. And this is why you still have to be smart with how you're managing your money. Number one, I think we're going to have higher inflation for longer. And so the idea that you should be going out and buying long-term bonds is just crazy to me. I think you're way too soon. I think it's way too early. And I think you need to be very, very, very careful before you do that. There may be a time at some point where that makes some sense with part of the portfolio, but I just think right now is not that time, because remember, the Fed only impacts the front of the yield curve. They only change the overnight lending rate. So when you see the Fed cutting a half point or cutting 0.25% or 25 basis points, as it's called, all it does is it lowers your money market yield or the yield you get from your bank in interest. But it doesn't really have a whole lot to do with the 10 or the 20 or the 30 year. Remember, all those other parts of the yield curve are determined by what? It's determined by trading, by the bond market. And so bond market traders, after the first Fed rate cut, when we got the 50 basis points, was, by the way, kind of a bigger cut than we thought. What happened to the 10-year? It went up 100 basis points. You're thinking, how in the world? This is so backwards from whatever I learned, that if the Fed cuts rates go down, the bond market could possibly go up, that bonds would get crushed on their prices. They go, hey, it's not hard to figure out, because now what is the bond market pricing in that they weren't pricing in last year? That we are not going to have a recession. And if we do have a recession, it's not going to be as severe as people thought. Now, will we have a recession at some point? Sure. But by the time you know about it, it's way too late. The National Bureau of Economic Research calls it like a year later or 6 months later. So it doesn't really matter. You know who's going to tell you if we're in a recession? Companies. The stock market will be down before the recession is called. Remember, the stock market's a forward-looking indicator, but also the bond market's a forward-looking indicator. So if you want to know where yields are going to be a year from now or 5 years from now, well, guess what? The bond market's already telling you. We think that in a year, the bond yields will be about the same right now as they are today. In 10 years, we actually think that yields are going to be about the same as they are now. So we may be going into an environment where yields are higher for longer. And it's my opinion. Now, I'm not a bond trader or anything like that, but we've been doing this long enough now where it's my opinion, from studying all the numbers, studying the data, studying the research on this, that when you're in a higher for longer period, meaning the long end of the yield curve is in that 4 or 5% range, I just think it's premature to go out and buy the long-term bonds because, and Jamie Dimon has pointed this out, this isn't just Nick Stenger at Stenger Family Office saying this. This is Jamie Dimon, the CEO of the largest bank in the world, at least the country. And he says, hey, 10-year could go 6-7%. If you avoid recession and you have a normalized yield curve and you get back to a spot where the 10-year is priced appropriately, I think 6 or 7 is high. I don't think that's right. But let's say it goes to 5. You still have a lot of room downward, I believe, on bonds. So just be careful. That's number one. Number two is I think equities are going to do well. So yes, even with higher interest rates, you think, hey, equities are going to struggle. Not the case, because, at least my opinion, not the case. Why? Because just like the Fed doesn't influence the 10-year, they do influence the overnight lending. So if you get a more normalized yield curve, and let's just say the 10-year drops and or goes up and it's right around 5. Well, that means probably the 1 year or maybe the 2 years right around 3, somewhere in there. That'd be a pretty normalized yield curve. Well, that's actually a good thing for other companies who are taking on debt. And so if you're a company and you're going to have to refinance some debt, you actually may see lower interest rates depending on what the rest of the yield curve does here as the Fed keeps cutting. But on the back end of things, just be aware of the fact we may not be out of the woods on inflation. And so if you want a really good long-term hedge on inflation, look no further than equities. Look no further than stocks. Dr. Jeremy Siegel covered this in Stocks for the Long Run extensively. We had him on the podcast. If you didn't listen to that show yet, go watch it. It's on YouTube, our best show, biggest show we've ever done. And Dr. Siegel talks about this. It's just like the 80s. You had 19% interest rates under Paul Volcker when Ronald Reagan first came into office. And what did Reagan do? A lot of the same stuff that Trump's talking about. Let's cut regulation. Remember Reagan standing there in the Oval Office with the big old stack of regulations saying we're going to get this thing down. That's the Federal Register, the number of pages of rules there are. So we're going to get that a little bit lower. Okay. Then we're going to shrink the size of government. We're going to shrink taxes. We're going to get the economy moving again. So despite Paul Volcker's high interest rates, because of the good policy changes from the Reagan administration, love Ronald Reagan or hate him, he had some good policies. It got the economy moving to the point where equities did really well. I mean, the 80s were one of the best times to be a holder of U.S. equities. And so I think the same thing is going to be true today. We may have a rocky road on long-term bonds for a while. But at the same time, I think equities are going to do well, especially equities that are reasonably priced. Should you be going out and pay 200 times earnings for a stock? No, I think that's a really bad idea. And if you're doing that, you need to ask yourself, what kind of a plan or what kind of investment plan am I on? If you're not on a good, disciplined, goals-based plan where you're buying what I would call our quality growth blue chip companies, you really need to I think you should rethink things. But what you really want to do is say, okay, what are these companies doing? What are next year's profits going to look like? Are they growing revenue? Are they growing earnings? And are they preparing for a rainy day? You put some basic screens on these companies. You look at what they're doing to protect their balance sheets. And as long as their companies and the CEOs and the management teams are using common sense, you'll be fine. You'll go through a downturn. You're, of course, going to have a correction when the market has a correction. You're not going to be protected in any stock. But over the long run, what will happen is you'll bounce back. You'll recover. You won't get completely wiped out. So that's what we try to do for our clients, is just put some guardrails around their plan. That's what we talk about on the rebalance. That's what we talked about last week at Investor Day. And by the way, if you did not get to make it out for Investor Day in person this year, get the dates on the calendar. We have the date. It's tentative, so it may change, but it's October 9th and 10th. We're going to bump it up a month next year, 2025, October 9th and 10th. Don't miss that thing. If you missed it this year, you got to get on the calendar. We maxed out our capacity this year. We're going to expand it to, I think, 160 to 170 people next year. So there's even more room. So get that date on the calendar if you haven't been able to make it in the past. So all this to say, this is a historic day in the stock market. S&P 6,000 points. I mean, this is just absolutely incredible. This is a testament to you staying on your plan. This is a testament to what you've done to just ignore the noise. And that's what we try to do on these shows. That's what we try to do with the podcast, is just say, stay on your plan. Don't worry about the nonsense in the background. Don't worry about the narrative. Stay focused on the data, and I think you'll do just fine. So will you be up a year from now? I don't know. I think you will be. I'm not sure, though. I don't really have a crystal ball, except for that one from Amazon we have in the podcast studio that doesn't work that well. But in 5 years, I do think you're going to be up. In 3 years, I think you're going to be up. And I think you're going to be happy you stayed on your plan. So thanks for being with us for episode 166, S&P 6,000, pretty good. We'll be back next week. We're going to try and get back to the regular schedule for the rest of the year next week with episode 167. We'll see you next time.